So we're talking about an exchange option where I give Q1 of stock 1 shares and I give Q2 of stock 2 shares, I get Q1 of stock 1 shares. So here's our payoff, and we derive some theory about that, but let's actually go in and use some real numbers and price these things and compare the different techniques that we have. So to test this idea, let's look at Dunkin's and Macy's. And these Dunkin' Donuts and Macy's are kind of the example that is often trotted out about stocks that are negatively correlated. You want to spend money on a little treats for yourself. If that times are good, you're spending at Macy's. If times are bad, you can't afford Macy's, so you're shopping at Dunkin' Donuts. That's the theory. So with the price that Dunkin' and Macy's are at right now, sort of a fair exchange would be you get 1 share of Dunkin' if you give 10 shares of Macy's. So you would only exercise this if your 1 Dunkin' share was worth more than 10 times a share of Macy's. Let's go and look for some data then. So stock 1 is going to be Dunkin'. I went to Yahoo Finance, and first thing, so before we go to, let's look at the data, the numbers that we need to get. I need to know the stock prices for the 2 stocks. I need to know the volatilities for the 2 stocks, standard deviation of the returns. We've got the Q1 and Q2 because, they're written in the option. It's about a fair trade, at least last time I checked. Dunkin' is worth about 10 times. 1 share of Dunkin' Donuts is worth about 10 times what 1 Macy's share is worth. We're going to say it expires in a month, so the time left is a 12th of a year. I'm going to put the risk-free rate of return at 0.02. That's actually way too high for what it is in real life now, but that's a more typical rate. Right now, the interest rates are very low. If I was following exactly what was happening now, I'd have to put in a 15th of a percent or something. And we also need to calculate the correlation of these 2 stocks. All right, let's go get our numbers. First thing, see, the last time I looked at it, it was like 59. So this is like a fluid number. But I'm going to put in what I see here, $60.02 for S1. Now, let's get our data, historical data. And now I've also got a decision. What do I want? I'm going to choose weekly, and I'm going to choose a year. Of course, I would get different numbers for the sigma and for the correlation if I chose a different timeline, right? I mean, let's open the data. Okay, there it is in Excel. I'm going to use the adjusted closes, so let's get rid of that. I'm not going to use the volume. There should be a year of data, and they used to give the data upside down with the earliest at the bottom and the late, but now they give it in numerical order. Now, this is Dunkin'. We want to deal with the returns. So the weekly returns is going to be equal to now our average return is going to be the drift. I don't need the drift, right? I need the standard deviation for the volatility. Standard deviation of the sample of these. Okay, that's not the volatility yet though, because I have to scale it. I have to scale it because this is weekly data. So 52 weeks a year, I want this number to go up. I'm going to multiply this number by root 52. Okay, so here's my volatility then. Let's make it 0.58. So volatility, 0.58. Now I got to get the same thing for Macy's, and then we also need the return numbers to get this correlation. So I'm going to go in here, look for symbol, look up Macy's. Another good thing about Macy's is that it's easy to spell M for Macy's. So here's Macy's, $5.93. So that 10-to-1 ratio, Q1 and Q2, that makes good sense. So $5.93. Macy's is $5.93. And all I got to do is get the sigma in the same way. So I'm going to go gather the data for that. Get the returns, standard deviation of the returns, annualize it, just like I did for Dunkin'. So I did the same thing with Macy's and got a volatility of 0.75. So let's put that in. So Macy's volatility, 0.75. And I'm also noticing here, if I open the Macy's spreadsheet, because we put in the close at around $6. A year ago it was $22. So it really fell. That would probably, that might account for, some of the volatility there. But anyway, what we want then, let's look and see what we have. I have everything except for I need the correlation. Now we could manually calculate the correlation by getting the drift. So we could do this. We could get the drift of each stock, which would be the annualized average return, and then get the difference in each return, and then have the difference between the returns in Dunkin', the difference between the return and its average, and the difference between Macy's and its average, multiply them together. We do all that, but Excel has this already coded in for us, so I'm just going to use what Excel has. So here I put down on the same spreadsheet, I've got all the Macy's returns, weekly returns, and I've got all the Dunkin' weekly returns. So data analysis, correlation, okay, input range, and here it's built for us our correlation matrix essentially. This would be like the sigma, but really it's this that I want. That's the correlation between the two of them. And I'm going to call that 0.52. Oh, but there's a thing here. Let's stop for a minute. When I got the volatility, I got the standard deviation of the returns, and then I scaled it weekly. But here I just used the weekly returns. Should these be scaled? Should these be scaled weekly, like scaled up to annually, and then the short answer is no. We don't need to scale them. And if you look at the formula for correlation, you see that it's divided by the two, it's covariance divided by the two sigmas. That takes care of any scaling. So long story short, no, I don't have to worry about it. So I have everything that I need now. I have all the input numbers that I need to calculate. So we've got three different methods that we're going to look at. We're going to look at discounted expected value. We're going to look at that analytical formula that we made, and we're going to look at Monte Carlo integration. So let's start with Monte Carlo integration. So here's the S1, S2 plane, and I've drawn the line S2 equals 1/10 S1. This is sort of the dividing line between where I would get money and where I wouldn't get money, where I would exercise the option and where I wouldn't exercise the option. So we're talking about in here is where I would exercise the option, where S1 is bigger than 1/10 S2. So let's think about then our integral. I'm integrating d. I think I'm going to do y2 first, because y2 has to do with S2, and S2 starts on the line S2 equals 0 and goes to the line S2 equals 1/10 S1. So all the way through this shape, we're starting on S2 equals 0, S2 equals 0, and going all the way to S2 equals 1/10 S1. And then S1 is going from 0, well, technically S1 is going 0 to infinity. I can't put an infinity in here, so I'm going to make a decision. The stock is currently S1, that's S1 is Dunkin's. It's currently trading at, let's say, around $60. So I'm going to put an artificial wall here at I get to pick, and I'm going to pick $100. Is that a good choice? $1,000? You should experiment with that. Run it with a couple of things. But I'm going to pick 100, and that's a choice I make. So I'm only integrating in this region here, this triangular region. All right. So here's our Monte. Here's our integration that we made. We only have 2 stocks, so I only need to integrate twice. We've decided we're doing y2 first and then y1. We're going from 0 to y2 over 10, right? We're integrating with respect to the y's. No, y1 over 10. And then y1, that's for the Macy's, is going from 0 to, we chose that, or I guess I chose that, to be 100. The payoff, our payoff is equal to the max of 0 and Q1S. So we're only integrating in this region where it's positive, so I'm not going to go max of 0 and Q1 S1 minus Q2 S2. I know we're in this region, so it's the Q1 S1 minus Q2 S2. So this payoff is then Q1, which is 1, minus Q2, which is 10. So that's our payoff. Okay, we need these alphas. Well, let's get this correlation matrix. There's only 2 of them. And our correlation between, I didn't even write 1, 2 because there's only 2 stocks. So this is 0.52 here. I thought it would be negative because the whole story, one goes up when the other one goes down. Times are good, you're shopping at Macy's. Times are bad, you're shopping at Dunkin's. It looks like Dunkin' is just winning. So anyway, we got our correlation here. We've got our alphas. Let's make our 2. Let's put our 2 alphas in. Now n is equal to 2, so 2 over 2. That's just a 1. We can get rid of that. Time left. That's a 12th. Interest rate, we made that at 0.02. Time left, we made that at 12th. Oh, I need the determinant of that sigma. So this determinant goes in here. We only have the 2 sigmas, sigma 1, sigma 2. We'll fill those in. We have numbers for those. What else okay, well, let's fill in those sigmas then. Sigma 1 is 0.58. And sigma 2 is 0.75. So this front part is all, I mean, that's all numbers. We're integrating, oh, we need the inverse of this matrix in the alpha. We'll figure this, I just need to, the only thing left for me to do is like clean this top part up here. So let's get our two alphas. So going to have alpha 1 and alpha 2. So stock price 1 is $60.02. Stock price 2 is $5.93. The y's we leave because we're integrating that out, y1 and y2. The risk-free rates of return, 0.02. The time left is a 12th of a year. Now we got to put the sigmas in. Sigma 1 is 0.58. Squared. Okay, so that's all numbers except for the y1. Sigma 2 is 0.75. And, oh, I got to put a 12th in here, right? And now that's all numbers except for the y2. I need the inverse of this correlation matrix. And now I want to build this top piece here, which is going to be this vector times this inverse times this vector. This vector as a row vector times this matrix times this vector as a column vector. This. Okay, everything is numbers in here except for y1 and y2. When I go simplify, it's going to spit out this huge thing with ln of y1s and ln of y2s. Actually, it isn't too big, right? That's not too bad. But anyway, there's what it is. That's the thing. That's what's up here. And now I guess then let's put it in here then. This. Now I'm set. It's do this integral with Monte Carlo methods. So we're going to have to pull out our Monte Carlo code. So got the Monte Carlo, got the MATLAB open, the Monte Carlo. What it's the area. Remember, we have to calculate we have to take the average value and then multiply it by the area of that triangle. The area of that triangle, since we went out to 100, the area of that triangle is 100 times 10 divided by 2, 500. So that's what this is. It's sampling. If it's picking a random number in this rectangle, but if the point is above the line, it picks again. So that's what this is doing here. If it's y2 is above the line, it chooses another point. So once it gets through this while loop, it's picked the point that's below the curve. This top is our this piece here samples. This whole front matter is that is this 3.9. Anyway, so the area times the stuff at the front times the average of the total. I'm getting a price for this exchange option using Monte Carlo integration of $4.43. All right. Now let's look at the analytical formula. So this is the analytical formula we made. Remember, we have to make that special sort of combined volatility. Once we find that combined volatility that has the two volatilities of Duncan's and Macy's and their correlation coefficient, it's just a straight plug and chug, and I end up getting then calculating these two D's because it's basically like a call formula. Then it's Q1 times S1 times N of. Remember that this N of D1, let me grab that. I'll draw it on top of here, but so N of D1 is the area from minus infinity up to that D1. So since D1 is a negative number, you're getting an area of less than 50%. So D1 is a little bit, this side is 0, a little bit less than 0, so we're getting an N of D1 is a little bit less than a little tiny negative number. D2 is a little bit more negative, so we're getting a smaller probability. That's the 0.41% and 48%. Anyway, work this out, we get an analytical answer of $4.86. So the Monte Carlo integration is a little bit under. Finally, we've got our other price using discounted expected value. Now, this is my favorite way to price things because it's easy. Right? Here's the payoff, the expected payoff. We know how to generate the possible stocks, possible values of the stock. We just replace the drift rate with the risk-free rate of return so that we're pricing at risk-neutral probabilities. We have our way of calculating these n's that are correlated random numbers, and expected value, literally discounted. That's what the e to the minus RT times the discounted value. We'll open up our code here for this, and it loads all the values in. I'm calculating the X3 here as using this weighted combination of the two, like we did in the previous videos. And the code is short, right? We calculate the 2x, the payoff, and here's my discounted sum, and then I discount it. Run it. We get $4.97, a little bit bigger. Of course, there's random numbers, but it's always about $4.90 for the discounted expected value. A little bit above. So Monte Carlo integration was a little bit below what I guess I'll call true value, because this is like the page 200 formula, and discounted expected value seems to be a little bit above, but those other two methods have random numbers in them. Now we've got three ways to price a basket option. Well, we've only got three ways to price this exchange option, or we've got three ways to price this exchange option. Let's say it that way. If it was another option, another kind of basket option where we couldn't figure out that analytical formula for it, I would have to go with only the two ways: discounted expected value and Monte Carlo integration. If I had to trust one of those two ways more, I would trust the discounted expected value because there's less chance of making an error coding it. Also, I would expect the numbers to be fairly close. Here they're all like 4 and a bit. They're not as close as I would have liked, but we could maybe run it with more random numbers. There was probably a problem here because I stopped at 100. I'm missing all of the possible future values that are bigger than 100. So there's some ways that we can improve upon those